With that, let's bring in Thomas Hayes, Chairman and Managing Member of Great Hill Capital.
Great to be here, Anne.
Thomas, let's talk about Jerome Powell's speech to the Economic Club of Washington this afternoon. Can you just break down for us what his latest narrative is? I know he was specific in some areas, and what it could mean for the markets in the near term.
Well, in simple terms, Anne, he had a second chance to destroy the market and he didn't take it. So that's good news, and the market is up on that. He acknowledged disinflation was starting, so he repeated the fact that he is cognizant that inflation is coming down. The rest of the market's known that since June. So that's certainly a positive. But he also did a little walk back and said we have a long way to go. We've certainly seen the disinflation in goods. He wants to see more in services. He wants to see wages come down. But the thing that we have to keep in mind after seeing that monster jobs report, number one is there's going to be more hikes now. That's clear. Certainly 25 basis points more in March. But the other aspect is the market seems like it can take it. You know, Milton Friedman once said, it's not the price of money that matters, it's the quantity of money that matters. And they pumped 40% of GDP into the market in 24 months. So if they withdraw a couple trillion and they raise the cost of capital, it may not be the end of the world, particularly when you're seeing the labor force participation rate starting to move up and the average hourly earnings starting to slow down. So they're achieving what they set out to do in spite of a very strong underlying relative condition.
Let's talk a little bit about that jobs report, Thomas, because we saw the data come out. It was robust. We saw jobs being filled with much higher rates than had been expected, and you just pointed out that labour force participation, which means the proportion of the population actually choosing or able to go into the workforce going up. Talk a bit about why the fact that this job data, which has been strong, and which I was going to say this, for the community's sake, we want people out there in the jobs they want, getting the incomes they want. But the fact that the job market has been strong, has led to wage inflation, has been a bit of a headache for the Fed. So talk us through what the latest jobs report means and why it could be an issue or at least a factor in the Fed's long-term monetary policy.
Well, the bear's case has been that people are spending up their excess savings and they're spending more on credit cards. And that's going to be a bad thing because you're going to see defaults and you're going to see a downturn in the economy. What they didn't calculate is the fact that when people run out of savings, they go back to work. And that's a positive thing. So what we're seeing is that increased supply of labor is actually ameliorating the upside pressure on wages with just a 0.3% jump month on month and 4.4% year on year, which is reasonably below December, which was up 4.6, and that's been dropping every single month. So I think people running out of savings is a net positive for the Fed's goal of easing up the labor markets simply because it's going to bring a lot more supply on. Right? When people run out of money, they go back to work, and we're seeing that right now, and that's going to be a net positive as we look out a few quarters, and I think the market's sniffing that out.
Thomas, I'm actually looking at Bloomberg right now, and I can see here in an article which is headlined, Powell says further rate hikes needed and markets take heed. The quote here in Powell's conversation with David Rubenstein is, quote, "We think we're going to need to do further rate increases. The labor market is extraordinarily strong," end market. So that's as prescriptive as I think we've seen it for a while. What do you think that means for the consumer in terms of the consumer sentiment? Last week, in recent weeks, we've seen that data be a little bit spotty. Later this week, we'll see an update to the Consumer Sentiment Index. What are you expecting to see?
Yeah, so consumer sentiment is correlated to inflation expectations, and we've seen those roll over from about 320 down to 220 in less than a year. The other thing that Powell emphasized, which was also bullish for the markets, besides the word disinflation, was data dependent. Now, he said more hikes may be needed, but he's going to be watching the labor reports and he's going to be watching the inflation reports. And the inflation reports have been very, very positive. They peaked last summer. The labor reports, we'll see how that happens going forward. But job creation may be fine. If we get another percentage of people back into the market, wages will remain subdued, and it's the best of both worlds. And what we're seeing right now in this new bull market, and I remember we spoke in the fall when everyone was despondent and under their desks, and I said, listen, this is where you want to be a buyer, not a seller. If you look at cash positioning, you'll remember I said it was as low as it was in the pandemic lows, the great financial crisis lows, the tech wreck lows. It was time to be a buyer, not a seller. And what falls the most in a bear market bounces the most in a new bull market. And that's exactly what we've seen year to date here, Anne, with tech and semis leading the way, communication services and consumer discretionary. And we think that trend is going to persist.
Let's switch gears a little bit, Tom, and let's talk specifically about the NASDAQ. Tech has just absolutely pummeled in 2022, but January's been a really strong month for the market. The Nasdaq's up 15%. We look at other sectors more broadly. The S&P's up around 7%. How do you think about tech valuations right now?
I think it's and not to use a cliche, it's a stock picker's market. But I'll tell you one thing: if you can pick up Amazon at $101, I know we talked about it with you last time when it was in the high 80s, but it's pulled off a little bit since earnings. You've got a business you can buy at 2018 prices. The only difference, Ann, is the AWS business has tripled over that time period. The ad business has tripled over that time period. The e-commerce business has doubled. The only problem is they overexpanded in the warehouses during COVID, and Andy Jassy is going to fix that problem. And you already saw it with the layoffs, and they'll shut down some warehouses. They'll make it efficient. They'll make it lean and mean, and you're going to have a monster business when you look 3 to 4 to 5 years out. And you probably have a double on your hands, and you'll have a nice IRR in a business like that. So we like that. Do we like the nonprofit businesses that are losing money and promising the future and delivering very little in the present? We're not interested in those businesses. But cash generative businesses like Amazon, we love emerging markets. As that dollar has come down, you've seen Alibaba rally over 100% off the lows. That was when we were pounding the table in the fall. We think it's extremely cheap. A gift, that balloon this weekend was a gift from, manna from heaven for those who missed it. The move up to 120, you could buy it at 105, hold on to it for a couple, 2-3 years, and have a beautiful return with one of the best businesses, with AliCloud, with their e-commerce business, and with a government focused on consumption moving forward to ignite the recovery in China post-COVID. So there's a lot to do here, Anne, and we're very we continue to be optimistic. We were in the minority and maybe a little bit alone in October and December when we spoke. Now more people are coming on board, but the train is just leaving the station.
On that note, Thomas Hayes, Chairman and Managing Member of Great Hill Capital, thank you for joining. That's it, folks. We got the closing bell imminent. Thank you for tuning in. We'll see you all here.